Hey, what's up, everyone? Welcome to Ask Me Anything. The BYOB Money Multiplier team is here to answer all your questions regarding infinite banking, becoming your own bank, alternative investments, and anything in the financial world.
All right, let's get into the questions here. So the first one we got, this is a pretty simple one. I recently came across your stuff. Where can I contact you to chat about doing this? So I'll put a link in the chat box here. Let me go and find it. Where to go? There it is. I'll put a link in the chat for you. So it's mentors.beyourownbanker.com, and that'll get you in touch with one of us. So there you go. So I just put that in there. What is the strategy for starting a child's policy if I have an 18-year-old daughter and want to make sure she can do IB, infinite banking, when she graduates college? So who wants to take that one?
Sure. I've been designing a lot of kids policies lately. So one is really, like Craig was saying in the beginning, you're already talking about helping her learn this process. So if you want to make sure that you have and are practicing this yourself, and if you're not, you have to at least have a certain amount of death benefit on your body or your spouse's body, because kids' policies are reverse engineered off the parents' policy, up to half of their death benefit, up to $1 million typically. So depending on how old, right, she is, if she's 18, you want to help her do it when she's graduating college. If she's not independent yet, it'll be based on you guys' death benefit until she's earning income.
Yeah, there's lots of cool things you can do with starting a kids policy. You know, even at 18, recently had a conversation with someone who loaned money to their daughter. Their daughter's making payments back to them for the car. And we talked about, why don't you just open up a policy and start putting that into the policy, you know, for her. So it'd be a policy on her, just start storing all that money in there. So the parent would still be controlling the policy, own the policy, but at some point it could become the daughter's. So that was a really cool strategy, just to kind of, you know, take the daughter, put it into a policy for her benefit. She doesn't really know what's going on, but it's, you know, behind the scenes, she'll be building that up for her.
Yeah. And I got a client right now that's a new one who has a policy through, not one that we would typically set up. It's IUL, but it's made for college. But they're taking loans out for the college, and they're asking, well, now what do we do? Well, make your kid learn how money works and pay it back. First and foremost, you know, be responsible with your banking system. So, but I have a little case study that recently came up with a lead where they have infinite banking. They've had a policy for 15 years and didn't know how to properly use it for 15 years. And I'm so glad we had a call with them, because otherwise they may have imploded the whole thing. So we'll do a little discussion about that here in a little bit. All right, from Anderson DRA, I'm taking out a HELOC instead of refi, like we talked a little bit about last week. That's awesome. Do I just use the HELOC to pay debt down faster, or can I take a loan out from the HELOC to start a big policy to multiply the benefits? Ooh, got a few moving parts and pieces in that one. Who wants to tackle that one?
Yeah, what it comes down to there, the way I've approached that in the past, Anderson, is we've got a tool called Debt Blaster, and I'll just put the HELOC debt in there to see how does it play out using the HELOC versus not using the HELOC. And there's always long-term and short-term benefits to either approach. So short-term, you'd probably pay the debt off faster by just taking the HELOC, blowing away the debt, you know, and being done with it. Long-term, can you get that money into the policy and start compounding? You know, there's definitely some benefit to that. So I think it just depends on your numbers, the debt, how much is going into the policy. So there's a lot of variables we'd have to work through, but we do have the means to help you solve that mathematically.
Hey, you just want to chime in on that one?
Sorry.
All right.
Like doing two different things here. So I've always got mixed views on this. I always say, let the math run the decision, and, you know, using the HELOC to pay down debt faster versus, you know, taking the HELOC, put it in the policy, and then do that. You'd really have to look at both scenarios. I typically would think that just taking it direct from the HELOC and repaying the HELOC could work better, but you're going to give up some long-term benefits by doing it that way. So you got to weigh out the death benefit. You got to weigh out the compounding effect that it'll have 5 years and beyond to really make that decision. But either way, it's going to work just fine.
The only other thing I would add to that, did a case study for a gal a while back. Now, this adds an element of risk to the whole equation, but if you took the HELOC money, put it into something that generates passive income or generates income, that then pays the debt off. So at the end of it, you've got the asset still generating, you know, income of some sorts, and you could do it that way too. But like I said, it adds that element of risk. So what if something happens to that investment? Now you've got the HELOC, you've got the debt, and the investment blew up. So you just have to be careful with stitching some of those types of things together. But I'm on board with what Chris said too. Just let the math solve the equation for you.
From Dan says, do you think cash value whole life is a good protection against potential taxes against unrealized gains that Harris has proposed if elected?
Is this the same that brought up the comment earlier?
Yeah, we talked about this on Wealth Webinar today. So they're talking about unrealized gains, which, Dan, the proposed unrealized gain tax is just absolutely stupid, but you already knew that. And probably no chance in hell she'd ever get that passed through Congress. But let's just say she did. Supposedly it's supposed to be on, correct me if I'm wrong, gentlemen, on 100 million or more. Is that what it was? I think it was 100 million or more. But even it won't stay at 100 million. It'll go down and down and down. And then all of us will be paying tax on unrealized gains. But the beautiful thing about the policy is private. Like there's no reporting at all. So what are you going to report, or what do you have to report that would ever trigger an unrealized gain? So I think this, again, life insurance would be one of those asset classes that's just kind of skirts over that whole thing if that ever did actually become a thing.
And Chris, do you think the politicians are using this same strategy, and would they want to ruin that?
We already know the politicians are using the policies. We know Joe Biden funded part of his political campaign. So did McCain. So yeah, we already know who's got the money in them. I mean, I don't know if Harris or Trump do, but they just haven't gone public to say that. But the rest of them do. The Rockefellers and Rothschilds, the Morgans and the Stanleys. I mean, all those families are using this. So why would we think that they, the other two are not? Well, Harris probably isn't, but I'm going to leave that one alone.
Yeah. All right. Oh, this is a follow-up one from Anderson. Was thinking of doing velocity banking like Christy Van does, then just start a policy after. So there you go, Chris. What you mentioned. That makes sense.
We like that because then you're not adding any additional risk input in your house and things like that. And with it, especially if your HELOC's variable, I mean, it's supposed to be, we teach surplus money depending on who you're talking to, but surplus money running through this. So,
yeah. And Jason, I really love that approach because everybody's got a different threshold of risk, and I'm pretty conservative on what I do, but some people are a little more risky, and that always plays in the equation too. So, but absolutely.
All right.
Who is that furious typer?
Who's the mad typer?
That's Steven.
Who is that? They're so fast.
Oh, it's always Steven.
Carson.
No.
Joey Tracy, I have a niece and a nephew that are not Americans that are Bermudian. Wow, that's an interesting one. I've never seen before. One, can I take a policy out against them? One under 18, other one is 18, and is there a way to take a policy out for them? Straight answer is typically no. Have to be U.S. citizens, have to be located here. So in most cases, that's a negative, unless they're for some reason U.S. citizens or born here, have a social security number, that kind of stuff, and come here once or will come here throughout the year. Then you could potentially do one. I had a client that is a U.S. citizen, social security number, hasn't lived here for over 10 years, has a policy, but they come to the U.S. on a consistently. So short answer is no on that one. Anybody else want to chime in on that one?
That's right.
Yeah. All right. King of Israel. Let's see. What types of assets do you guys have or recommend to get with the IBC? Well,
meaning what should we invest in from our policies, right?
Yeah. They're thinking, what kind of assets do you use to acquire through the infinite banking?
You want to go, Carson?
Yeah, I was just going to say real estate for me. That's all I'm doing is buying rental properties and doing syndications, lending, depending on the time of the market, the amount you have available, or what your time is and how much you can spend into it. I like real estate personally. And so based on all those factors, it depends on, the deal depends on those different factors. I do, and I'm a part of all those different types of investments in real estate. And so that's what I'm personally in, but I think we always would tell you invest in what you like and understand. If you have a business, go invest in your business. If you are a huge stock or options guy, go do that. So if you don't know what to invest in or what you like, then go and discover, figure out, try a few different things, do some research, and learn from guys like these in here who are all doing different types of investments. But for me personally, it's real estate.
Yeah, so far for me, it's been investing back into the mission of this, and to getting the message out there, to impacting more people. And then it's going to be going out and doing other things. But I don't know. When I look at where can I get exponential growth and return, I want to invest in something I believe in and I'm doing, right? And I really love. So,
that's a great point. Like, imagine if you put $1,000 on a YouTube ad and you get 2 leads from that. That's probably going to give you a much higher return on the investment than if you spend $1,000 and put it in the S&P 500, right? So it depends on where you're at. And I think investing back in your business, Jason, is a great thing that most people, business owners specifically, should be doing.
Yep.
And I'll second that. I mean, I've been doing this for a long time where I've been lending money from my personal policies to my various companies, and I've done it for copy machines. I've done it for covering payroll way back in the day. I've done it for marketing campaigns that we've needed. And even now I will be doing it to fund the future, like tech builds for Private Money Club. And the only thing that's important about when you use it for business is treat it just like you're a bank. I mean, don't just lend money blindly to your company and be like, well, hey, it's my money and, hopefully it can pay it back. Set up a note, set up an amortization schedule or some type of terms, and literally have your company set up a bill pay. Like we're literally, I don't want to say militant is the right word, but that's what we are. We're militant about how we use the banking system. There's not a single time that I take a loan for my policies that I don't structure a note. Even if it's one of my properties, I spend the money and file a mortgage on it. Literally, I treat it just like a bank, and I make payments back every time. I mean, you could ask anyone on the bookkeeping side or Melissa or Brandon, like we literally set up a bill pay and a recapture for every single loan that we send out there. I've also used it for real estate. I use it for all these cars in this garage. That's been a big thing for me, is building up a car collection. And then lastly, I mean, I lend a lot out. We use the banking system to lend money through Private Money Club. So I wouldn't say that's an asset, but the note and the mortgage is an asset on the balance sheet. So if you look at my personal balance sheet, like all those mortgages for the private loans, those are all assets, not liabilities. So that's how I do it. I don't know.
And Chris, I love when you jump in and you talk about your mindset and your diligence and you call it militant, right? I know every time I hear that, I think I got to get better at that. Like I got to get better at being more dialed in, understanding, being, the process. But you're really talking about the mindset. You're talking about teaching yourself the habit, and you started it from your first policy. Like you've told it many times on here. Where you're like, yeah, I was paying $265 a month back to whatever it was that you were paying back, and I did it line of credit. I did it for like 10 or 11 years, even though it was probably paid off in 5. You just get in the habit and you keep doing good habits. I had someone say to me earlier that was a fighter pilot. But he's like, yeah, if you're going to teach this, I'm not going to teach you to fly a fighter. I'm not going to build you a fighter pilot or give you a fighter pilot if you can't even fly a plane, or if you don't even understand how the principle works. Like we really have to keep focusing on the mindset, like Chris was just teaching us. So.
Yep. And I'll add one last thing to this one is that I've had some people that come in and they want to start getting assets, but they have a massive pile of debt as well. So it's what do you tackle first also as part of the process and part of the educational process. Because if you have a massive pile of debt, does it make sense to invest first or to use IBC to tackle that debt and get rid of that first, which then frees up more cash flow and can allow you to do more things. So it also depends on your situation. Just keep that in mind as
Brian,
well.
that's a really important thing. And it's probably something we don't cover enough, although I just think people are smart enough to just assume that that's the best path. Like if you've got debt, especially credit card debt, don't ever invest any of your money from your banking system until you've paid down your debt, because it's the best return on your money. It's a guaranteed double-digit return paying credit cards off using the banking system. Like that's always the first part.
And you've taken all the risk away. If you go into an investment, it is not guaranteed. When you're stacking a guaranteed policy with guaranteed contractual, growth in it to a guaranteed debt, you got 2 guarantees. You're not going to screw
Especially if your
up.
credit cards are 20+%, like where are you going to get an investment that gives you 20+% consistently and persistently without excessive risk? A good thing Joe's not on here, because he'd be like, oh,
I
you
was
don't even
thinking exactly
understand
that.
risk. You don't even understand risk. So like, hold your comment.
Yeah.
And I told Joe on the last drive, I'm like, Joe, I hope we never have to have this discussion, but I think we're going to again, where I have to sit you down and say, I told you, I warned you. And then he says, I know, I should, I could, I would. I hope that never has to happen.
Yeah. Thanks. Actually, a follow-up question to that one from Night of Israel is, what's the minimum amount of money you need to lend in the Private Money Club, PMC?
Gosh, I don't know. Steven, what is, or Steven jumped off. I think the minimum I've seen lent on there is $5,000. I mean, I always used to tell people $25,000, but I know now that like there's other opportunities to jump in on deals. I've seen $5,000 go to work in Private Money Club.
Yeah, I saw like 30 seemed to be the most common low one, but I saw 25 and 5 there recently. So those are some good ones.
The other approach you can take, which is not something I would want to do, but you can typically get in on cheaper amounts if you take a second lien. So that could be something to consider.
Yeah.
It's not my
Hit
favorite
this one-
thing.
yeah. Hit this one real quick. So David and Dorothy says, Chris and team, what type of accounts are included with the Harris proposal for unrealized gains? Yeah, I don't know what types of accounts. I don't think they know either. It's a shot across the bow right now.
It's definitely here. I'll give you, I mean, basically, this information, this just so everybody knows, this is stuff you easily can do. I mean, both of the presidential candidates have really outlined and laid out their policies. So you can just go on and you can read their policies like I had to, but I've made it a little easier by creating a video. Now, I'm going to forewarn you, I'm going to give you guys this video, but if you are a Kamala fan, you might not like me after watching this, but it's just my opinion. But I go line by line through her policies, but I give my own opinion on them. So I'm going to put this in the chat, but I'm expecting no one get mad at me for this, because you're probably going to if you're voting for Kamala.
Next one. What's the minimum investment for a policy like this? So depends on the individual. We usually recommend minimum 10 times your age per month, depending on your age. If you're typically above 60, it can be up to 15 times your age per month. That's the recommended minimum to start. So there you go. If it's a juvenile, it can be a little bit different, though. It can be a little lower, but same kind of applies.
I like the "it depends" answer. It depends on what your problem is you're trying to solve. Like, if we don't know what the problem is, it doesn't really matter what you think you might want to put into it, because it's not going to end up going anywhere for you. So
yeah. I had someone recently was like, I'm 50 years old. Can I do 150 bucks? I was like, no, it's not even worth it. Not even worth it.
One of the things I started doing in a lot of the calls, we run so many calls, and it took me, I'm kind of slow. Like, it takes me a long time to figure stuff out at times. It took me like a year and a half to think of this. But now when someone starts sharing all their debts, like our focus is debt, I'm like, I usually start with this question instead. How much are you saving a month? How much are you paying yourself? And if the answer is a big fat zero, it doesn't matter how much debt they have, because they're not practicing the first principle that we're teaching, where the surplus money is going. So then my next question is like, well, do you have a retirement account? Is anything going into that? So that's kind of where I would start with. I lost the name of who it was, but that's where I would start with. That is kind of, how much are you saving per month? If it's nothing right now, if it's zero, then the first thing is to see where you might have financial leakage, kind of weigh in, write everything out, see where you're spending money, really understand what's happening. And then from there, you can start having the goal of paying yourself 10% of what you're earning.
Yeah. This is a good question here. Steve asks us, how does one sell this concept? Use it yourself. The number one answer is experience. Have it yourself, use it yourself, have the experience yourself. First off, we don't sell this thing. We don't sell it. We talk about it, we teach, and we educate. That's the first thing, is you don't sell it. The more you educate, the more you give people information or value, then they're going to want to talk to you more about this. So one, don't sell it, just give value. Two is use it yourself, use it in your own life, so that you can then share your experience. And that's really how I think a lot of us, and Chris, if you go look at his videos, how we actually are, if you want to stay selling it, that's how we do it. We just share what we're doing. That's my first answer on that one.
Well said. I mean, and the one thing I always tell people, I might not say this publicly, but might as well here, if anyone ever came to me or Steven saying, hey, how do I sell IBC? We would never return your phone call. Like I would blacklist you until you learn that you don't sell IBC, you teach IBC. And then when you teach it the right way and you show people how to solve their problems, people will ask you to help them. It's a totally different process. It's not a sale. It's a sales process, I guess, at best, but you're never selling. They're asking you to buy because you're solving a problem for them. Too many people want to sell a product because that's how they think they're getting paid. But if you come into this thing wanting to sell a product because that's how you make money, you are already dead in the water and you will never succeed doing this. Sorry to be
people feel that. I mean, you may be a good salesperson, but at the end of the day, this is changing people's lives, right? This is about the not about the man, it's about the message that we have. It's about what this actually does for families. Like, we're all here because we have proof. We believe, like, we are believers in the biggest way of how this works, what it is. So, I would just watch our words, right? Our words make our world. So when we're saying, how can I sell this? No, how can I teach this? How can I educate? How can I make more impact in the world? Would be a better frame. I didn't even catch that. So that was awesome, Chris.
Yeah. And actually, follow-up question to him is, how long does it take for someone to get certified to be, like us? I mean, that depends on the individual, I'll be honest. It really depends on, how long it takes you to get into this, learn it. Everybody has a different journey. All of us have a different path to get to where we're at today. So I would just say it depends on you and what your goals are
Yeah.
with this. Because here's the thing, most of us all have come to infinite banking because of something else we were doing, investing, learning, educating. I acquired a financial education business that talked about this. That's how I came into it. I learned it from Robert Kiyosaki's advisor. One of his advisors is the one that I learned it from directly. But we all have our own little journey, so it's really kind of up to you. So that's kind of my quick answer on that one. So,
has anyone commented on Carson's awesome hat?
It is
we
an
had it
awesome hat.
backwards for a while.
Yeah, he made that. That thing looks great.
Thank you.
How many of you guys are certified through the Nelson Nash? Well, most of us. We're all actually in the process.
Now that is a fantastic freaking question.
Yep. Yeah, I'm trying to figure out where my binder's at. It's here in my office somewhere. Right. We're all
And
going
back to how long, like Steve asked how long it takes, or someone asked how long it takes.
Steve did.
Yeah, it depends on your, like, I went through the process super slow. Like, I'm a nerd. I was outlining it. I'm like, I got to read this book. I got to read this book. And I asked Carson, like, I was way ahead of Carson. I was at like the 70%. I left for like a week to go hike up a mountain. I come back and Carson's finished it. And he hadn't even started yet. He did that. And he's like, I just watched all the videos. I looked at the questions, and it was the easiest test I've ever taken. And I was like, I thought it was pretty hard.
It was hard. There was nothing easy about that test. And like, I like to think I know a lot about this stuff, including economics and Austrian economics and all those. And boy, that test was tough.
You had to know what Nelson Nash's favorite color was and everything. Like what?
I didn't even watch any of the videos. I just used the notes, and I got it done in a week and a half.
Yeah. See, so it's going to depend.
You definitely could get it done in a week and a half.
Well,
it's going to be a grueling week.
Are boring. They were the guy needs a little bit of training on how to speak.
Yeah.
You know? So
no, he's no longer there. So keep that in mind.
And took the test. Done.
Well, the good point is there's a lot of great content in the Nelson Nash training. So
Yeah.
take your time, read through it. If you're trying to learn, then you won't be so concerned about the time frame and just go through it. But like what Chris did for our group, he made a proclamation. I don't know, it was beginning of the year or when it was, but like everybody in our team will be Nelson Nash certified. Mm-hmm. So kind of lit the fire, and we all decided to go do it because one, we want to, be part of what Chris is trying to build here. But it's, every time in Nelson Nash, he talked about the arrival syndrome. Anyone remember what the arrival syndrome is? It's a thing that just make you rot faster than anything else. You think you know everything. You think you've already done everything. Everything there is to know about infinite banking, and there's not. There's the thing that surprised me about that program was all the Austrian economics pieces of it and the history, and it's like, holy smokes, lots of good stuff.
How long Nelson? I mean, he started learning Austrian economics, and if you guys remember, it's either 52 or 56, like 1952 or 1956 when we started studying it, and he went all the way through like the 80s, right? He had like 35 years in life insurance. He had 10 plus years as a forester, helping, evaluating, plots for trees and different things like that. So he combined two things when he had a problem and came up with a solution. But the backstory of that is like 30 or 40 years of thinking. And that's something that's been present too. I've seen a lot of speakers in the last week and a half is sitting down and doing more thinking. Like really understanding what your outcome is, what you're trying to accomplish. And like, that's what you get the most from going through that program, I think.
Yeah, I agree.
Absolutely. All right. Next question we got here from Christopher Smith. Debt or keep the 5K as reserve cash funds until I grow the policy a bit more? I think the question here is asking a piece.
Yeah, what is the question?
I think what he's saying is he has debt and he has $5,000 of cash as well as reserve fund.
Keep the reserve. You got to have you got to have a reserve, but the policy's cash value could definitely be the reserve. So you could, I would say, knowing what I think is coming, I would definitely say a reserve is very important right now, but debt's not going to be good going into this either. So that's a tough one.
Hey, Brian, he's got
an
an initial part of that question, 2 more up if you go up a couple more.
Oh, there we go. Started my IBC policy May this year, $1,500 a month deposit. That's a nice policy, $1,500 a month. That helps a lot. Total deposit of $10K so far, paid off $5,000 credit card. Should I take the other $5K and put it on the next? Yes. Okay. Now that I've got the full story, yes, I would, because I don't know your credit card debts and what they look like, but keep on the path of paying all the credit cards off. And I would say once you get the credit cards paid off, then maybe set aside the reserves before you pay off like a car loan anything else, but the credit card's got to go. So keep the path and get rid of the credit card. Sorry. When we were just reading that about the reserves, it didn't make sense. Now it makes sense.
Sure. So here, Carolina land. Do dividend paying whole life policies offer interest and dividends, or are the terms used interchangeably?
That's a good question. Nobody's ever asked that, but they're totally separate. Yeah. So in the contract that you get when your policy is issued and you fund it is a guaranteed interest rate. Okay. So like one of the companies we do is 3.25%. That is guaranteed for the life of your contract or as long as you live, if you keep it around. The dividends are separate, but where you're probably getting confused is when we refer to it, we refer to the dividend crediting rate, which is the rate that the dividend crediting rate. It's kind of, I hate the way they do that, but that is a combination of the dividend and the guaranteed interest in a blended rate. So like if you ever hear like Mass Mutual, says their dividend crediting rate is 6.2%. That is the dividend plus the guaranteed interest. So Carolina, you're not wrong in kind of being confused with that because it is a bit tricky, but just know they're two separate things. The guaranteed interest is that it's guaranteed contractually, and then the dividend is paid every single year, one time a year, and that is not guaranteed. But all the companies we deal with have never missed one and paid them consecutively each and every single year, in some cases for 162 years. I guess how old is this?
170, 160, 137, 148, 100.
You got them all memorized? Man, I got to do that.
So I found out something interesting the other day. I got one of our family businesses in Nebraska, electrical contractors, started in 1905, and that's when Lafayette started. And so it's pretty wild. It's like, holy smokes, to see Lafayette was, going on back then. And One America's 120 something.
148. 148.
I was going to say, you said 120 earlier. I knew there were 140 something years old.
148, they started in 1877. Then you got Security Mutual Life in New York is 137. You've got Guardians 160, and then Penn Mutual is the oldest at 170.
Yeah, I think Mass is in the 160s as well. Just crazy to think. They've been
around and it came from a mutual society, right? Like it came from, like when you start looking back at the history, the more we can connect what really worked in the past, because everything's not working now, right? Like you look at what the first policy loan was 1848. And it was because, guess what? People had money problems then too. Is that surprising to anyone?
Yeah, imagine that.
Imagine that.
Oh, be darned.
Silent investor. Love that one.
Carson had something right there.
Yeah, to that question, talking about the interest real quick, interest and dividends. So I get this question all the time too. Is the interest and dividends earning on the premium or on the cash value?
Cash value.
Cash value.
Cash value, right? And so is that a gross interest or a net interest number? Is that if you have $100K cash value, and it's 6%, you're earning $6,000 in cash value?
Well, you are, but minus the cost of insurance. So it is. So that's what you're earning, but then you got to take away the cost of insurance, the policy service fee, and any commissions if it were first year.
Yeah. So I think a lot of people come to us and say, well, if in my spreadsheet, 6% a year, my cash value should be a lot more than this.
Right, because death benefit is free, right? You should just buy insurance and it doesn't cost you anything.
Yep.
Yeah, we should work for free too. Even though we're already working for a reduced 60 to 90% commission, that's okay. Yeah, Carson, I love it when people pull out the spreadsheets and they're just like, well, these numbers don't make sense. Like 6% on the money I put in is this. I'm like, what the fuck planet you live on?
Chris, anyway. beginner's mind. I was just sharing with Carson before this call. My friends challenged me. I was saying, I'm going to speak to real estate investors and X, Y, and Z. And they're like, hey, where your energy needs to be to really reach people is you got to remember where you were before you started. What were you concerned about? Have the beginner's mind. It's really hard. We've been doing this for a while and teaching this and talking about it and constantly. Like, how many hours a week do we talk about this and do shows? But that beginner's mind, right? To keep that keeps a little WTF out of it. So,
all right, let's get to we have some more questions here. Let's see here. If my annual premium is at $36K and I loaned 60% of that to make it go to work and have the interest pay back to the loan, do I have access to the $36K and the loan amount I paid back at the end of the year? So I think what they're asking here is if they have access to the loan amount plus the interest they paid back into it. The answer is it's kind of actually related to the one we just talked about.
Yeah.
The interest and dividends are two separate things. So the way the dividends work, as we just explained, they go into the cash value less the cost of insurance. So does your amount that you can borrow against go up at the end of that year? Yes, it does. Not by the interest you paid back on the loan, but by the dividends you earned by being a part owner of the mutual insurance company.
Also, the interest that you pay back to the policy. So there's two schools of thought, right? So some people take loans from their policies and all they make are the minimum interest payments back to the insurance company. If that's what you do, the minimum interest payment, like the 5.2% or whatever the insurance company charges, that goes to the insurance company. You don't realize any of that. That isn't how I do it. So if I take a loan out, I'm never going to take a loan out of my policy unless it can go somewhere to earn a higher interest rate than what the insurance company is charging me. So if the insurance company is charging me 5.2, I will never send my money out to work for anything less than probably 6%, because I want to make that spread. I want to make money twice. I want to make the spread on what the insurance company's paying me, interest and dividends, minus the cost of the loan. And on the other side, I want to make a spread on what my money's earning or what I'm able to recapture minus the interest paid to the insurance company. So I'll just use a car, for example. Like car loans, on the last car I bought were about 7.25%. So I took a loan from the policy. I bought the car, but I had already had the dealership calculate what the interest or the payment would be if I were to have financed it through Chase Financial, because that's who they ran it through. And that was at 7.25%. So they gave me that payment. So I pay my policy back exactly the same amount I would have paid Chase Financial, because what's the difference? Like if I would have paid Chase that amount, why wouldn't I pay myself back? But that 7.25% gives me a spread, because if it costs me 5.2 and I'm paying myself back at 7.25, the exact amount I would have paid the car dealership's finance company, like I'm making more. So, and I'm not saying that that's right for every scenario, but if you just train yourself to think like a bank and act like a bank, you will never ask questions like that, because you will never send money out to work unless your money can earn for you. And if you pay off a credit card, and that credit card's like the next one, Trixie says 29.99. What's 29.99% minus 5.2? Does it matter? It's enough, because then you make the payment that you were making to the credit card back to your policy. You're literally paying yourself 29.99%. Why would you just make the minimum payment to the insurance company for the 5.2 when you were giving more than that away to the credit card? So much of the confusion around the infinite banking concept comes because people just don't think like banks. And it isn't hard. You go to a bank every day. You've borrowed money from a bank. There's never been a time you've borrowed money from a bank where the bank paid you more interest on your money you put on deposit, and then they charged you the same or less for a loan you took from that bank. It never has ever happened for anybody. So why would it be different if it was your bank? If you owned a bank, would you pay somebody 3% on a deposit account and then lend them money at 2%? Hell no, your bank would go out of business. Well, think like that, and your banking system, your private banking system will flourish. If you don't think like that and you start stealing from your bank or stealing the peas, as R. Nelson Nash said, your bank will not be a very lucrative bank.
Yep. And I had a question. Someone asked this one, and I'll put it out to the group. They said, if you pay your bank back with more interest than you're being charged, will you ever hit the MEC?
Well, yeah, you will. That's why you have the segregated account. So every time you do that, so that's a great question. Every time you would do that, if you paid yourself back more than interest, you're always going to max the policy out. That's great. When you max the policy out, now you got a bunch of money sitting in that segregated account. Guess how I have started all these additional policies? I just opened 2 more policies. Vivi's just got issued. That's her second policy. And I just started another policy on myself. And I'm not doing huge policies, folks. Let me preface, like the newest policy I just set up is $2,000. Yeah, $2,000 a month. And why is it $2,000 a month? Well, it's because I have an extra $2,000 a month from my banking activity coming into the segregated account that I can't put into the policies because it will MEC them. So that means now if I've got $2,000 extra every single month, I'll be damned if I let KeyBank hang on to that. So I said, nope, I'm going to set up another policy, redirect that $2,000 a month. Now I just added a branch office to my banking system. But you see, like, I know I've been doing this a long time, so sometimes I can't understand why it's complicated in the beginning. But when it was the beginning for me, I had a hard time wrapping my head around these things. But just stop trying to figure it out and just start thinking, how do I operate, or how do I interact with a bank And if the roles were reversed and I owned the bank, how would I operate? That's it. If you were going to pay 7.25% for a car loan, then pay yourself back 7.25. If you were paying Visa 29.99, then pay yourself back 29.99. Any questions?
Yep. There you go.
So
That is a common one I
Changing
get.
one thing. We're changing one thing. Where does your surplus money go first? Everything else you treat the same, right? Don't change everything else. Just change that one thing.
yeah, I try to keep things simple. I'm just not that smart.
No, I'll go along with that. Same here. I want it as simple as possible.
Here's an interesting question. Does Chris Ruud have a minimum lending amount at Private Money Club?
Not necessarily, because like a lot of Chris Ruud's, like there's a deal right now Chris Ruud's got. I think it's 205,000. Let's just, it's 2.5 or 2.15. So like 3 lenders could come in on that and take that deal down. One might have 15,000, one might have 50, and the other might make up the difference. So it really doesn't matter with Chris Ruud's deals because he's in Florida and he's got a really good attorney and title company that knows how to structure the mortgages with multiple investors. So I wouldn't say he has a minimum lending amount. You would just need additional lenders to come in with you if you were doing like 10,000 or 20,000.
Luke asks, wait, how do you get a return on paying off credit debt? Well, the return is because you're not paying the bank interest. You're paying yourself the interest. That's the bottom line, is that credit card and credit debt just sucks money away from you and you get no value out of it. I mean,
But that is a great question. That's a great, great fundamental question. Like,
Yes.
but the answer is so simple. A lot of times people just don't arrive at that answer because they're thinking it's so complex. It's not.
It's that you have more money in your hand.
If you're giving away 29.99% to Visa, then when you pay yourself back the exact same amount you were paying Visa, what's the return back to you? 29.99.
Yeah.
A lot of times these types of questions come down to really thinking about opportunity cost. Every time you do something, what is the opportunity cost? So if I'm going to pay cash for something, what's the opportunity cost? If I'm going to put the dollar into the policy first and then go buy that thing, so just kind of thinking about the life and the journey of that dollar, and maybe some of that will help you kind of think through, should I buy this car in cash? Should I run it through the policy first? Should I, so that's the way I've kind of started thinking about things, as opportunity cost. This dollar
Explain
has a
opportunity cost for someone, Craig.
What's that?
Explain opportunity cost simpler for someone.
So if you have a dollar and you go spend it on a car, that dollar is now gone. You're not going to have the ability to earn more money on that dollar, right? So that's a sunk cost that's gone. So, if you're taking that dollar and let's say you go put it into an investment that generates more money, and this is one of the things I like to do with my policies is put them into things that buy the things I want. So if you go put your money into a private lending deal that, sends you $500 a month or $1,000 a month, there's your car payment. So there's just different ways of stringing that together. But if you start thinking through what use is this dollar going to be doing at the next move? Well, if you spend it at the next move, it's done. It's gone.
Thank you, Craig. That's kind of what I wanted to get a little bit more depth on how your thinking works. So
sometimes you just gotta draw me out a little bit more.
Yeah, that's it. And hey, quick shout out for Rob Lenz and Chris from New Jersey, Chris Chamberlain, both guys I talked to today. So awesome dudes, and they're both really learning and starting to understand how this works. I told both of them, hey, it'll be a little bit uncomfortable as you go through things because you're growing, you're changing, you're learning things, but you just keep taking the next step and follow the path we've already laid down for you and the support that we're giving you. So,
yep.
Well said.
And a follow-up question that Luke asked here. I'm 30 and I currently have 25K in my retirement account. I want to find something that actually works for me. So yeah, I mean, obviously you're doing your education, your research right now. So you're in the right spot as far as I'm concerned. Yeah. So,
but Brian, first off, like 30 years old and he's got 25K saved up. Like that's pretty good. Most 30-year-olds have pretty much nothing saved.
Yeah.
That's just kind of the new norm. So congrats to you, Luke, for getting on it and actually saving and for realizing that maybe the retirement account isn't right for my needs and goals because I don't want to wait till 59 and a half. And shit, is it even going to be 59 and a half? I did a WTF today showing the stats of like retirement. Like we're going to be forced to work longer in later in age because we're living longer. So who knows when they push that limit from 59 to 65? Well, we'll see what happens.
I saw something the other day that used to have like with Social Security, and I don't know if I'm getting the ages right, but I don't know if it was in the 40s or the 50s where the expected, time that we were going to pass, our life expectancy was like 62. The retirement age was like 3 years after that. So like, think about the problems that it caused everyone who planned all of that we all start living longer. Right?
It's a major issue for Social Security.
Yeah.
Major issue.
I mean,
And
there's
Social Security's
been
broke.
government leaders in South America saying, well, we just can't afford people living this long, like literally saying that on public, on the news.
The only
I'm going to
solution.
leave that one alone.
Yeah,
Yeah.
the only solution there is just everyone
COVID?
start going to McDonald's every night for
I
dinner.
didn't say that, did I?
McDonald's every night for dinner.
Yeah, you won't live to that long. So that issue, I have some other questions here. Is it true the cash value interest rate is compound interest, and when you loan on the cash value, it's simple? Yes. So what's the golden rule? Earn compound, pay simple. And that's exactly what infinite banking does. So by the way, uninterrupted compound. That's powerful right there. So yeah.
Sounds like it's raining. It's raining keyboards.
Carson is a monster with that
He
keyboard.
is.
Carson's
me?
killing the keyboard.
Who here in this room took typing on an actual typewriter in high school? All right.
Remember how
I
they had,
failed that class.
they had the cards over the typewriter so you couldn't see the keys?
Yeah, I failed that
Beat your
class.
fingers if you look down at them.
I am happy to say it was either 6th or 7th grade. I miserably failed typing.
We did in high school. That was a high school class for me.
Another question: What happens if you max out your policy and can you still use it for infinite banking? Well, yeah. I mean, most of us are maxing out the policies into cash flow and assets, and then paying them back, and then cycling it back through, back and forth. So, absolutely.
Maxing it out means in that specific year of your policy.
Yeah, I mean, if you're not using the policy, that's fine. It's up to you. But we do advocate to put it to work for you, whether it's debt, whether it's assets. I mean, put it to work. Now, why I have clients that aren't doing that because they want to have forced savings, which is fine, rainy day funds. That makes sense. But yeah. All right, Rob Lenz here. This is a long one. So when starting the policy, only debts that I have is a home at 2.75% and a car at 5.75. I have $25K on car. If I have the cash value or have the cash, should I pay off the auto loan first or dump into a policy, take out the loan for a car? Well, I'm going to tell you, we're going to be biased on that answer.
Yeah.
We just talked about the opportunity
Both
cost.
would be. Here's the best way to say it. Both would be a good decision, no matter what. But using the infinite banking concept, forget about the policy for a second, but using the infinite banking concept, if you were to do that, if you took the $25K that you have and you paid off the car loan, don't stop there. 99.9% of the folks out there that would take that would pay the loan off for the car, and they'd call it a day. That's a losing proposition because now $25,000 can no longer work for you. You lost the opportunity on $25,000. The right way to do it, just what the infinite banking concept is, the process. Again, I said, forget about the policy for a second, is you pay the car off. You take whatever that car payment was, that 5.75% payment, let's call it $500, and you take that money and every month you make that same payment you're making now, but the car loan's gone and you pay it back to your bank account. At the end of the term, you'd have all the money back that you just put out to pay off that car, plus the interest that you would have given away. So take that concept, but now imagine adding one thing, which is the specially designed whole life. Now, when you do that, you got $25,000 that earns for the rest of your life and never stops compounding. That's the infinite banking concept.
You just helped Rob so much, Chris. This is a conversation we had earlier, so I'm glad that you came in. I mean, he's actually
sometimes it's easier to just eliminate the policy because that's where the confusion comes in. Just get rid of the policy and just teach the process, the circle, and everybody's like, oh my God, yeah, that makes perfect sense. Okay, great. Now imagine that $25,000 earns a guaranteed interest rate plus dividends in a tax-free environment for the rest of your life. What would that look like? Probably pretty good. So add the policy first.
And it gives you the legacy because if you have children and family, and that's super important to you as well, right? So you're getting that second guarantee. And so, I mean, Rob will recapture $7,800 a year paying off his vehicle with the policy.
Wow. And I love when people say my home mortgage is 2.75. I'm always like, no, it's not.
No, it's not.
That's not what you're paying. That might be what the stated rate is, but you can't realize 2.75 unless you keep that mortgage for 30 years and pay it all off. And so what you need to do is go into the fine print of your mortgage document. Now you're going to find something you don't like. And that is that you're probably paying more like 70, 80% interest because of the velocity of money, not because your interest rate's not 2.75, but the velocity of how you're paying that interest. That's where you lose. And that's what most people don't understand. I think that is the biggest scam that is going right now. I truly
still
believe that
don't
is the biggest
understand it.
scam and the biggest stealer of wealth from all American families.
I
The
still don't
American
understand it.
dream.
I still don't understand amortized tables. Like, call me stupid. I just don't get it. I understand the volume of interest. I see how much comes out the other end.
Because if you're on the bank side, you understand it because they're the ones that created it back in the 50s to really sell the American dream, by the way, and sell low interest
Brilliant, man.
and low payments. I mean, I have the
It's
conversation every
brilliant.
day. It's amazing.
Don't hate the banks, mimic the banks,
the
because that right there is single-handedly one of the most brilliant financial moves any business could have ever done. It just sucks for everybody because you're all screwed because you're paying the bank all your money in interest. And you don't even know.
And you can go buy notes and get that volume of interest as opposed to being, paying it. So mortgage notes, without picking them up, yeah, it's that volume of interest where they front load all of those interest payments up front. And then what most people do is refinance every 7 years and reset the schedule.
Yeah, here's one. The minimum interest payment that is due has a due date. If you miss the due date, they take your dividends as payment, correct? No.
Nope.
It just accrues. I think is what he's saying.
Yeah, it just rolls on principal in year 2.
Well, actually, no. Antonio, they wouldn't take your dividend, but they would take the interest from your cash value.
Yeah, interesting. It's a good question, though. So Derek asked, since when are policies investments?
Somebody had asked a question a while ago and said, if I invest in a policy, I think that's what Derek's referring to as just picking up on that.
Cool. All right, I'm going to hop on this call.
Yeah, policies.
Yeah, policies are guaranteed, so there's no investment risk. None. All right. Well, with that being said, folks, thanks so much for your time. That's a wrap for another episode of Ask Me Anything Happy Hour. Thanks all you guys for kicking ass and taking names. And we'll see you on the next one.